You are listening to Keystone's Stock Talk Show, episode 217. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. We have a busy show planned for you this week. I will start with a recent Your Stock Our Take question. I'm going to finish that off on Algoma Steel Group Inc., symbol ASTL on the TSX, one of Canada's leading steel producers, which just announced its fiscal year 2023 results, alongside some cost overruns for a transformational electric arc furnace project. Aaron will answer a viewer question on energy, transportation, and midstream service provider Pembina Pipeline Corporation, symbol PPL on the TSX, following the company's first quarter results, and look into its current valuations and growth prospects. Brett will answer a follow-up question on a company he looked at on this show in this past December, Plurilock Securities Inc., symbol PLUR on the TSX Venture, an identity-centric cybersecurity company that has shown strong revenue growth, but profitability has eluded the business. Last but not least, Brennan answers a listener question on cruise ship giant Carnival Corporation, symbol CCL on the New York Stock Exchange, which after being devastated in the pandemic has had a strong run-up year-to-date, but was hit today after it released its Q2 numbers. Brennan will let you know why and whether it offers value at its current price today. So let's get to the show. I'm going to welcome my co-hosts, Aaron and the Killer Bees, Brett and Brennan. How are you guys doing? How was your weekend? Anything interesting?
I went to Nickelback.
Yep. Nickelback.
That was good. Yep.
Yes, you did.
Look at this photograph.
Oh, please sing for us, Brennan.
So did they just made their way? Like they started touring 20 years ago and they just made their way to Saskatoon?
The music just hit
I haven't heard
Saskatoon.
that name in a while. That band goes back.
Yeah, but even when we were in Vegas, I saw that they were going to be in Vegas too, I think this summer as well. So, you know, they're at least they came to Saskatchewan before Vegas, I think. But no, the concert was good. Good energy.
Where are they from? They're from Alberta.
Hanna.
Prairie.
Yeah, Hanna, Alberta. Yeah. And that's kind of like the energy was so good in the building just because like they were playing the Prairie Roots and you know, so they
played up
people your age, right? Or
I'd say it was mixed. Yeah, it was mixed. It was
in their 70s or
your age
80s.
It was kind of all around. A lot of young kids too.
I just looked it up. The band is actually formed before I was born, Brennan.
Really?
Yeah.
Wow.
Nice. But they're not cool enough yet to be like classic rock. That's the thing. So, you know, they're kind of tweens or something in that.
Can't even
range.
say I really like their music even, but it was just fun to go with my friends. And what else
else
can you do in Saskatchewan? You know, that's the thing.
Not
Watch
much.
your dog run away for 2 weeks. Yeah.
Did you say your dog ran away for 2 weeks?
Oh, actually, it's funny because I went to,
Okay.
I did actually go to a comedy show, Jimmy Carr.
Oh, really?
You guys familiar? Yeah, I know. So I do remember. And he mentioned Saskatoon.
Well, he was just here as well.
Because he did a Canadian tour. So he mentioned Saskatoon and he said some joke about how like, you know, some people have this idea that Saskatoon is kind of like the Paris of the prairies.
What?
And then he's laughed. He's like, nobody who's been to Paris would ever say that, right? And he's like, nobody strolls down the Champs-Elysees and is like, this looks like Saskatoon.
Kind of reminds me of Saskatoon. Yeah.
So yeah, a couple.
Brennan might say that.
Saskatoon is pretty good.
Think I would. Trust
me, Saskatoon got off easy. Virtually everything else he talked about, he laid into a lot harder. So,
yeah. What about you, Ryan?
Good,
comedy.
I had my daughter's birthday this weekend. Well, it was her actual birthday. We'd had other birthdays leading up to it, but it was good. We went bowling, just took out like my parents and Candace's parents, and then But Eden ended up with some kind of stomach flu from something we ate, her and mom. So there was last night of barfing. It was pretty awesome. That really good 8th birthday, right? Yeah, no, I was okay. They're okay now. So it was fun times. We'll have a barbecue coming up too. So should be good. Yeah, hopefully probably just something we ate. And I'm not going to say what restaurant we went to because they're a massive sponsor of this show. So we won't say that. Or they could be. Anyways, I'm just kidding. Let's just get to the show. There's nothing else we want to get to other than Brennan later will discuss how he hates cruising and he'll talk about Carnival cruise. So we'll get into that. Yeah, that's a teaser. All right, I might as well start on Algoma Steel Group. This is following up a question. It was a two-part. There was a question that involved Algoma as well. We've talked about it in the past. Symbol ASTL on the TSX. Trades around $9.61, $995 million market cap. They are based in Sault Ste. Marie. Algoma is one of Canada's leading steel producers. The company has a production capacity of 2.8 million tons with products that include hot rolled coil, cold rolled coil, and plate steel. I love anything with coils in it, so I'm loving that. So this past Wednesday, Algoma reported its Q4 fiscal year 2023 results that came in slightly above street estimates, but well below fiscal year 2022 numbers across the board. The company released its Q1 fiscal year 2024 guidance that was well below the previous year. Additionally, Algoma provided updated budgetary estimates for its electric arc furnace or EAF project that include significant cost and time overruns. The announcement was a surprise, as in late January of this year, Algoma reported the project was both on time and on budget, and now we find out it is not. Let's look quickly at the numbers, the Q4 fiscal year 2023 numbers. Consolidated revenue down 28% to $677 million. Net loss was $20.4 million compared to net income of $242.9 million in the prior year quarter. Adjusted EBITDA, $47.9 million. That's a margin of 7.1% compared to $334.4 million or a margin of 35.5% in the prior year quarter. So a massive shrinking there. Cash flow from operations dropped 78.5%. Shipments, however, were actually up in the quarter, 571,000 tons compared to about 547,000 tons in the prior year quarter. Now, the weaker year numbers were largely driven by lower steel prices. Revenue per ton of steel sold was $1,185 compared to $1,721 in Q4 of fiscal year 2022. And if you look at the cost overruns we talked about in that EAF project, Algoma's project will feature a pair of electric arc furnaces that will replace the plant's existing blast furnace, coke oven, batteries, and basic oxygen steel making operations. They will be far more efficient and should lead to better cash flows over the long term. Now, management surprisingly increased the budget for this project by $125 to $175 million. That would be total project cost of between $825 to $875 million. That is up from what they estimated just in January at about $703 million. So that represents 59 to 83% increase over the remaining capital yet to be contracted last quarter. It appears that the detailed engineering work for the project was completed about 6 weeks ago, and Algoma received bids that carried higher than anticipated costs. Additionally, supply chain disruptions, particularly related to microprocessing chips, are expected to delay the commissioning of the project until the end of calendar 2024 compared to the initial timeline, which was about mid-calendar year 2024. So current valuations very quickly. On a trailing basis, Algoma looks attractive. PE is 5.4. EV to EBITDA is 1.9. However, estimates for fiscal year 2025, so 2 years out, earnings and EBITDA are significantly lower right now. Those are the estimates from analysts out there. I'd call them guesstimates at this point, but they're for significantly lower results. The balance sheet quickly, cash, $247.4 million, debt, $122.7 million, so net cash of $124.7 million. Our take here. The electric arc furnace project appears to be a smart one, but the cost overruns and the launch delays are unfortunate near to midterm for the company. While management stated that internal cash generation and an anticipated working cap release of around 100 to 150 million should be more than sufficient to fund Algoma's capital requirements. Even with those cost overruns, we do note, though, that the company just filed a base shelf prospectus allowing them to raise additional capital. So the issuance of shares at depressed prices is a potential threat to keep an eye on for existing shareholders over the next year. Algoma, as with all commodity-sensitive businesses, is highly sensitive to the pricing of its underlying commodity, in this case, steel, for its profitability. The balance sheet is currently solid, which is a must. It's solid, which is a must for investing in a business such as this. But it could move into a net debt position funding that project, dependent upon the pricing environment for steel. If one believes that steel is headed higher over the next 3 to 5 years, as the more efficient operations are brought online, Algoma is interesting, but projecting the price of steel or most commodities is often tantamount to guesswork. As a result, it remains speculative as an investment, and given the near-term cost overruns, uncertainty in the economic outlook generally, we are not buying Algoma at present.
Yeah, and you make a good point. I mean, really looking at a trailing P multiple on a cyclical commodity-sensitive stock is irrelevant, and this goes for oil and gas, goes for mining.
Yeah.
You're always with any stock looking forward, of course, but with some companies, there is some certainty in the revenue and the earnings that they're going to be able to produce over the upcoming year, or some stability in the financial performance. Whereas in a commodity sensitive stock, there's nearly none. So what I always look for, I mean, if I am going to do research on a commodity sensitive stock, one, the balance sheet, I want to see minimal debt, because you just don't know what kind of position the company is going to be in to service that debt if commodity prices go down. Obviously, I want to have some assurance or some belief based on my research that the supply demand fundamentals of that specific commodity are favorable. And then beyond that, I want to see that the company is doing something to take advantage of a situation by, say, expanding capacity, as opposed to just being a commodity price taker where the earnings and the share price are going to go up and down with the underlying commodity. In some cases, you can find other ways to invest in the commodity more directly, as opposed to through a stock.
Yeah, for sure. And then that is one of the pluses with Algoma. They do seem to be modernizing the facility, bringing more capacity online, and particularly it should be more efficient as well. So, I mean, if you saw steel pricing boom again, or you saw a positive environment for them going forward, that would definitely be a plus. They'll be more profitable. But you can see with those numbers that I just ran through for that quarter, how fluctuative they can be. They actually had an increase in output there in the quarter, and the results were down tremendously across the board. And that's just the pricing of steel, really. I mean, they had some other, cost issues in the quarter as well, but primarily it's the price of steel. And, that can translate to any commodity-based business. And that's why it's very difficult to forecast cash flows for these businesses. And you're better, if you're it's hard to invest in them over the long term. It's more of a trade. So, Aaron was correct. If you're going to look at these, make sure you have a business that has a good, solid balance sheet. Often net cash is best. And then, some impetus for growth, but then all of that can be said and the commodity price can go against you, and you're going to do poorly that year, likely in that investment. But, if you have those things, at least you will survive for the next upcycle. That's what we're looking for if somebody is looking to invest in these type of investments.
Pretty crazy that they 59% overrun in costs is what you said.
On that, in the additional capital, and that'll be at minimum. It could be above that, but that's the additional added capital. It went from about 703 to up to I think it's 800 and something, right? So yeah, it's about 150 off the 703 million in terms of cost overruns, but on the additional capital, right, that's still left out there, it is 53 to almost 80% overrun. So, it is quite surprising that it's that much more, particularly when they were on time, on budget, and boasting that kind of at the start of January or the end of January. So not a significant time period, and not a period where we've actually seen commodities go significantly higher. over that period, they were already at that level. So there should have been, you would think, potentially some idea that there could have been a cost increases, particularly of that magnitude in January of this year. And as I understand, they weren't stated at that time. So, and they kind of just came out this past week.
Yeah, like I also, just to go on a little bit longer on it, I wrote a report for clients, a monitor report on the company back in January. And as well, when steel prices were really, really high, they ended up buying back a substantial amount of shares. I believe it was about 28% of all of their issued and outstanding shares. So, I mean, it was nice that they're,
I think it was significantly higher than they're priced right now, right?
Yes, I believe so, at $9.75 US per share.
So, yeah, US. So we're talking $9 Canadian right now, right? Something in that range. So, yeah, I mean, that's the thing. It's share buyback, but if you just bought in the market today, you'd be buying at a significant discount to that price. So,
yeah,
was it a good use of funds?
That's a good point.
We'll find out over the long term, depending on how well that project comes on and how efficient they are. So company to look at, certainly not the worst like steel producer that you can see. There's certainly more debt heavy businesses out there that we wouldn't touch, but again, you're just going to be beholden to the price of the commodity to a large degree. Now, let's look at a midstream service provider, energy transportation company. It's Pembina Pipeline. Aaron's really excited to get to this one.
Well, this is a company that I have looked at several times in the past.
Yeah.
As part of our income research, because it is a dividend payer and a high yield stock. But we recently got a question from Darlene. Darlene wanted us to take a look at Pembina Pipeline, specifically, I think the recent financial performance and the guidance, and then also compare the company to Enbridge. So I'll make a couple comments comparing Pembina to Enbridge at the end of the segment here. I'm going to focus mostly on the company and what they're doing and what we think about it. But here we go anyways. Pembina Pipeline, it trades on the Toronto Stock Exchange under the symbol PPL, about $40 per share. It's a $30 billion market cap company, and it pays a yield of almost 7%, so 6.7% right now. What they are is energy transportation and midstream services in North America. So these assets include liquids and natural gas pipelines, gas gathering, processing, oil and natural gas liquids infrastructure, and logistics services. Also a growing export terminals business as well, exporting LNG off of the west coast of Canada. So looking at the geographic breakdown of the company, they're primarily focused in the Western Canadian Sedimentary Basin, northeastern BC, as well as Alberta. A little bit of exposure in the Bakken in the U.S. and in Saskatchewan, and then as well the LNG facility on the west coast of British Columbia. Now, one of the things when we're looking at these midstream companies or these energy transportation companies is we want to know what the revenue structure is in terms of, do they have commodity price sensitivity? Is it contracted cash flow? So looking at Pembina's revenue breakdown, they have about 65 to 70% coming from take or pay or cost of service contracts. So take or pay basically means they get paid whether or not they provide the service. So they have customers that are essentially, paying them a consistent stream of income regardless of the usage or the volumes. There's fee for service. So this is where they get paid for the service, but there's not commodity price sensitivity. And then they estimate about 10 to 20% of the business is commodity price exposed. So by commodity, about 40% is crude oil and condensates, about 25% natural gas, and 35% natural gas liquids. And then on a divisional basis, 55 to 60% of the company is focused on the pipeline segment, 25 to 35 on facilities, and then 10 to 20% on marketing and new ventures. So this would be the segment of the business primarily that would have the commodity price exposure. Nothing really phenomenal about the company's share price performance over the last 5 years. If you've been investing in this company, you've primarily, depending on where you've purchased it, you've primarily been getting any investment return from the dividend yield. Pretty much flat with a fair bit of volatility over the 5-year period of time. And, this is not unusual for a lot of these energy infrastructure companies. They really have been primarily income plays. And this is especially true over the last year. Some of them have come under pressure because as a dividend income play, you are, of course, having to now compete with higher bond yields in a higher interest rate environment. So that puts some pressure. But Pembina's not done too poorly over the last year here. Really just about flat share price performance. So what we're really looking at from most of these energy infrastructure stocks, these utility style defensive contracted energy infrastructure stocks is, are we getting a yield? Are we getting a good yield? Is that dividend growing consistently year after year after year? Do they have the cash flow growth in the balance sheet and the payout ratio to support the sustainable dividend and the sustainable dividend growth? And then beyond that, any capital appreciation you get is really just additional upside potential. So the company recently put out their Q1 2023 financial results. Not really a great showing. 18% decline in net revenue, about a 6% decline in adjusted EBITDA, and adjusted cash flow per share was down about 9.5%, 9.4% to $1.15. And the adjusted cash flow per share is really one of the main metrics that we're going to look at. This is what, is really telling you what the company is producing in terms of growth on a per share basis. This is how they pay their dividend. This is how they fund their capital expenditure campaign. So we pay close attention to that per share number. Of course, adjusted EBITDA, revenue, those numbers are not unimportant. But growing the size of the business overall does not necessarily help investors unless you're also growing the business on a per share basis. And then dividends increased about 3.2% compared to the previous year. Last year in 2022, net revenue growth of just under 8%. Adjusted EBITDA was up 9%. And then adjusted cash flow per share, basically flat, up 0.4%. So not a lot of growth there, basically flat performance on that per share line that I told you to pay a lot of attention to. Common share dividends, basically up about 1.2%. So it's a situation where, certainly there's going to be some negative pressure on the company from higher interest rates. Those are not captured, of course, in the adjusted EBITDA line. This is earnings before interest, taxes. So, that's another reason why we want to pay close attention to the adjusted cash flow per share, because you are, as an investor, as a common share investor, that's really the value that is created from you, is that per share profitability. Now, just taking a look at the breakdown of the company going forward, the balance sheet, the valuation. So one of the things Darlene wanted us to look at was the guidance. Pembina is looking at 2023 full year adjusted EBITDA guidance in the range of 3.5 to 3.8 billion. So that's basically about flat or maybe slightly lower compared to EBITDA for the full year of 2022. Again, not a lot of growth. We would, with that flat EBITDA number, expect more than likely to see a continued decline in the cash flow per share as well for this current year. When we look at the balance sheet, one of the ways we're going to analyze this is on a debt to adjusted EBITDA basis. Pembina's figure here, leverage ratio is 3.6 times. I would consider this to be a healthy financial position. No concerns about the leverage ratio here, particularly for a company that is producing stable cash flow with the vast majority of the revenues contracted in nature. Valuation, trading at about 9 times adjusted, just a little under 9 times adjusted cash flow from operations. This, I would say, is about fair value in the market. I mean, I wouldn't consider it expensive. I wouldn't consider it particularly cheap. It's certainly good value, reasonably good value compared to the market overall. But of course, we're not seeing a lot of growth come out of the company. So we would just give this a fair value, say that this is about fair value. Dividend growth, 2.3% was the increase in 2023. They did increase the dividend 3.5% in 2022. So this is good. I mean, this is the type of company that we're expecting to see consistent year over year dividend growth every year, and it has been able to do that for the past more than a decade. So decent, albeit low single digit dividend growth, which is again what we would expect from a larger energy infrastructure stock like this. Payout ratio 55% of adjusted cash flow from operations. That's healthy. We consider that sustainable. No concerns there. So just in conclusion, on the positive side, what you're getting from this company is you're getting what should be stable operations, largely contracted cash flow, and a healthy balance sheet. And this supports that attractive dividend yield, and also the dividend growth. Now, we want to see that dividend growth supported by underlying growth in cash flow per share. We've not really seen growth in cash flow per share for the last year or so, but there are going to be ebbs and flow. There are going to be ups and downs there. So it's certainly not a situation where we're concerned, but generally speaking, we want to see that dividend growth reflect the growth in the cash flow per share. Now, on somewhat of the negative side, growth in cash flow per share has stalled, as we've talked about, expecting flat EBITDA in 2023. Also, Pembina is not as diversified as some of the other names. Darlene had asked about a comparison to Enbridge. And one of the things about Enbridge, so a lot of the fundamentals between Pembina and Enbridge are going to be fairly similar. Enbridge pays a yield of just a little over 7%. They're growing their dividend at a rate of about 3% per year. And the way we look at that is really, in terms of a total return expectation. So your dividend plus capital appreciation. If you're paying about a 7% yield, you're growing your dividend at about 3%. We would say, a reasonable expectation would be 10% average return over time if they're able to maintain that growth rate. So, this is a situation where for a lot of these companies like Pembina or Enbridge, you're getting a decent return over time, or you should get a decent return over time. Most of that is going to be in the income return. So we're largely looking at these as income investments right now. In terms of how they compete with bonds, well, bonds provide much nicer yields now than they have in the past. But one of the things that these dividend payers provide that bonds do not is they are able to produce consistent and stable growth in their dividends over time. This is not something that bonds provide. There is also the potential for some capital appreciation in these dividend payers as well. Now, one of the main differences that I would just highlight between Pembina and Enbridge is that Enbridge it's a much larger, it's a more diversified company. It's not just focused in the Western Canadian Sedimentary Basin. They have, although it's a small portion of their business right now, they have more opportunities to invest in, like, say, renewable power growth in other areas, which is something that they want to focus on in the future. But Enbridge is very much a North American diversified energy infrastructure company, whereas Pembina is more focused in Western Canada. So, if you're looking for a nice yield and you have moderate capital appreciation expectations, then these are the types of companies you can look at. Our favorite between the two is Enbridge, but that really comes down to just it being a more diversified and larger company.
Yeah, I think it's a good summary. And I think you kind of summed it up right at the end there, which we would prefer. And, it comes down to if you're getting that yield. I mean, there's not a ton of growth in these businesses. You're getting a good percentage of your return from the yield. And, the more diversified business may be the better bet in that case, right? So, yeah. All right, did you guys have any comments on that, or you want to just move to Brett's Plurilock?
It's all good.
All right, we're good. Let's go to Plurilock.
All right. Yeah.
I believe you answered a question on this. Was it the December time period last year? Was it in that range?
It was, I think, mid-December. So about 7 months ago from the time of recording.
Yeah. So we'll check in again.
Question. Yeah, we got another question from Garrett. He asked, Plurilock seems like it has a good product, but annoyingly, it keeps issuing more stock, diluting its value. We looked at this company, like Ryan said last year. We had very similar conclusion to the comments that Garrett had. But let's really look through what's changed over the last 7 months. And if you don't know, Plurilock Security, symbol PLUR on the TSXV venture. Plurilock Security Inc. is an identity-centric cybersecurity company that reduces or eliminates the need for passwords by measuring the pace, rhythm, and cadence of users' keystrokes to confirm their identities. They operate in a highly regulated industry, including healthcare, critical infrastructure, government and defense, and as well financial services. The stock is currently trading at 14 cents and a half at a market cap of 10 million and is up 3.5% year to date, effectively flat, depending on the exact trading price of the day. So a quick rundown of Q1 2023, their last quarter that they've reported. Revenue was up to 15.8 million from 7 million, a massive increase of 127%, but that's just largely due to they had 2 acquisitions within the year, as well as they do have a lot of fluctuation quarter over quarter because they're largely contract based. So if you look quarter over quarter, you'll see really big variations, and that should be expected going forward if you are looking at this company. 79% of the revenue did come from hardware and system sales, with 70% from software, license, and maintenance sales, while the remaining 4% from professional services. That's a big decrease from their hardware and system sales, which are more one-off in nature, which is a bit good to see. As well, you can see that reflecting their gross margin, which has been improving. Q1 coming in at 13.6%, which is quite a bit higher than previous years. Last year, it had a 6.6%. The increase is due, like I said, to the revenue mix, as more revenue came from that software, license, maintenance, sales, and professional service segments, which, of course, produces higher margin than hardware. However, profitability is still just poor. Plurilock had operating loss of 1.2 million, which is an improvement from a loss of 2.2 million, a net loss of 1.4 million, an improvement from 2.4 million, and on a non-GAAP basis, adjusted EBITDA was a loss of 1 million compared to 1.9. So improving, but still a loss across the board, regardless of what metric you're looking at. Plurilock does have a cash position of 1.4 million, that's including the restricted cash, but a net debt position of 1.9 million at this time, and they've actually paid off quite a bit of that over the last quarter. But like Garrett was commenting on, dilution is still occurring just regularly. At the end of Q1 2022, so about a year and a half ago, the company had 70.3 million basic shares outstanding. Now, at the end of Q1 2023, they have 87.3 million outstanding. So at the end of the quarter, so that'll be a year over year at that point, is a 24.3% increase. Some of the share dilution was related to acquisitions, but even taking that out, you're at 19% dilution year over year if they didn't acquire anything at all. So that's substantial, to say the least. Further, the company has 13.5 million of stock options outstanding and 13 more million in warrants outstanding at the end of the quarter. But that's not the end of the dilution. In June, the company placed another 5.3 million units, which is 1 share and 1 warrant in one transaction, and then they did a concurrent transaction with another private placement of another 4.9 million units. Both those transactions sold the shares at 14.5 cents for the current market price, but they also had the warrants, which had a strike price of 20 cents. So even if you were to see the stock price rise, you would see further dilution once it passed that 20 cent marks, and we're just seeing constant dilution, and that's how they're funding. So really, that's why they're diluting their shares, is they need cash over and over again. The last quarter did have positive operating cash flow, but this was really just due to working capital changes, specifically an increase of accounts payable, which will need to be paid at some point in the future before the working capital changes, which we can see here. Plurilock had a cash deficit of 1.2 million during the quarter. So in reality, when you're ignoring the exact timing of payments and working capital shifts, the company has been consistently cash flow negative. So they need to raise money through either debt or equity. And as interest rates have rose and rose and rose, every company pretty much in this position is starting to shift to the equity financing. So they do have a outstanding line of credit, which they did pay down during the last quarter, and then they've actually, I think, shifted that out into equity financing as well, and therefore some of the dilution. As well, it would not surprise me, the reason for the recent financing in June is they're paying down that accounts payable, which ran up over the last quarter, to make the cash flow seemingly be positive. But of course, it's not really. It's just really an accounting cash flow positive situation. So our take. The company is just far from any sort of recommendation this time. Yes, the revenue growth is good, but it does not make a company investable just off revenue growth. We've said this time and time again. You need the profitability. You need positive cash flows to become investable. They need to start producing cash flows from operations so they can stop this death spiral, I should really say, of dilution. If both share replacements close in the quarter, you'll see double-digit percentage share count increase just during Q2. That's just massive. If you're losing 10% of your effective share value quarter over quarter, that adds up very, very quick. You end up doing a rollback and you have 10 shares instead of 100 shares by the end of the year once they've rolled it back. And you've lost 90% of your value, most likely at that point. They're just not investable at this point. They need to get the cash flows. They need to get back on track before, even if they do have a good eventually financially investable product, at this time, the dilution just makes it so you can't. And I really want to drill that in, is you need to look at the financials. You need to see them start converting before you can really invest in the company, regardless of if the product is innovative or not.
Yeah.
And this is why, people often don't get the whole idea of why we look at profitability as a minimum criteria in a company. And that's because, at the very least, you should understand what the road to profitability is clearly, because if a company isn't generating profit from operations, and that means they need to raise money from debt,
you have to fund it somehow,
equity,
right? Yeah.
just to finance their expenses, right? And like, you could have a profitable company that issues shares or takes on debt for growth projects, but when you have to issue shares just to essentially keep the lights on, that's an issue that's not sustainable. And we want to invest in sustainable businesses. So, in some cases, there is a pathway that's clear to see to profitability, but it is an issue that a lot of investors don't focus on the profitability at all. And, if you are putting your money in a highly speculative company that doesn't have profits, doesn't even have revenue in some cases, or minimal revenue, you have absolutely no idea what the share count is going to look like by the time, and what percentage of the company you're going to own by the time it actually, makes that transition into net earnings, if it ever does.
Yeah. I mean, and it's a shame in this case, like the trailing 12 months revenue, 73.4 million. If you go back to December 2022, it was like half a million. So they, tremendous growth in revenues, and largely, made by acquisition, but the price to sales on this business is 0.15. That just tells you, like, if they could get any margin, like they need to get a good margin, but you got any margin out of this business. But that's why you trade at a 0.15 times sales. Like, it's just the business continues to dilute to keep the lights on going forward and keep funding any type of growth. And you don't see near term, you don't see a path towards significant profitability. And the path that we would chart at this point would be, at some point there'll be a rollback or a consolidation of shares, and that's because you're raising money at 14 cents or in that range, and it just, at some point you got to issue so many shares just to create any cash into the business from those shares. So at some point, that's what I would see for the business. I'm not close to it or anything like that, but that's what I would see happening. And then you do a rollback, and then, over that period, can you trust that management will continue to be good stewards, mind the storms in terms of a capital structure? And, at present, the revenues are growing, but Aaron said, if you don't have a discipline for profitability, there is really no investment case in the business until you get that.
And the market sees that, because look at the share price performance over the last 2 years, right? In spite of that impressive revenue growth, the market is concerned that
that's why you're at 0.15 times sales. Like, that is a massively low multiple to sales, but the market is not buying that those sales are going to lead to any cash flow, which you need to drive the share price higher. And the only way you'd trade at such a low multiple to sales is if you have a low margin or no margin business. And right now it's a no margin business, to be honest. So, okay, we'll move on. I mean, again, there's far worse companies out there. So, like, they've at least garnered some sales, but you need that profitability, and we want to invest in profitable businesses. And that's why you see the share price slump, because there is no profitability, and we keep hammering that, but we will. Brennan, you got something on Carnival Corporation. We had a discussion this morning on cruises. Brennan apparently just absolutely hates them, thinks that anybody who takes a cruise is a degenerate and shouldn't be. I'm just kidding, but you've never been on a cruise, though. So
I've never been on a cruise.
Brennan only took that position when he realized that you've taken a couple cruises.
That's true. It's true.
Another, so
anything that I do then is,
and a long-time ex-girlfriend used to love cruises, so maybe it's tainted in my view.
It could be the hate for the ex-girlfriend.
Brennan wouldn't take her on a cruise.
Yeah,
probably it. It's probably
confused out of principle.
So she's like, I love you. Just take me on a cruise. Never. I'm
not going on a boat. Anyways, so Carnival Cruise, or Carnival Corporation, sorry, CCL on the New York Stock Exchange. We got a question from Jeff, and he says, Carnival Cruise reports earnings next week. The stock is still depressed since the pandemic drop. Do you think there is an opportunity? So yes, the stock is down about 70% since January of 2020, where it essentially halted operations and cut its dividend due to the pandemic, of course. And today, which is June 26th, is the time that we're recording this, the stock is down about 7% right now, following its recent Q2 2023 earnings results. But earlier this morning, it was down 11%. But so it has recovered slightly. And right now it's trading at a price of about $14.65 and has about a $20 billion market cap. So Carnival Corporation operates a fleet of more than 90 ships, which visit approximately 700 ports under AIDA Cruises, Carnival Cruise Line, Costa Cruises, Cunard, Holland America Line, Princess Cruises, P&O Cruises in Australia and the UK, as well as its seaborne brand names. So looking at the financials for Q2 2023, which drove the stock lower today, but keep in mind the comparables that we're going off of from 2022 remain depressed, so this growth is kind of one-off. But revenue came in at about 4.9 billion, which was an increase of over 100%, but was an all-time second quarter record for the company. So even though they are seeing that huge jump because of depressed comparables, they still did have a second quarter record, which was good. Adjusted EBITDA was 681 million, which was a substantial increase from a loss of about 928 million in the same period last year. Adjusted EPS was a loss of 31 cents compared to a loss of $1.64 last year. And while the company is still losing money, customer bookings continue to show positive momentum, reaching an all-time high of 7.2 billion and surpasses the previous record of about 6 billion reached in 2019. And you can see the company really, they're always comparing back to 2019, of course, which was when normalized times were. So looking at the balance sheet, they have about 30.6 billion in net debt, with about 80% of that debt being fixed rates and the rest at floating rates. And the company has a forward net debt to EBITDA multiple of about 7.3 times and a trailing 12-month times interest earned ratio of about 0.7 times, which is a bit of a concern because it remains under 1. And just to look at the company's 2023 guidance, which I also have up on the screen here, it does look promising as the company is projecting to get back into positive EBITDA for the year, but adjusted earnings remain negative. And if we use the adjusted EBITDA guidance, the stock continues to trade at about 12 times its high end of EBITDA guidance. And to put this into perspective, that midpoint there, about the 4.2 billion in adjusted EBITDA that they're anticipating in 2019, they actually ended up doing, I believe, about a 5.5 billion in EBITDA at that time. Now, the reason I believe the stock is actually down in the trading session today is because in the near term, CEO Josh Weinstein noted that high labor, fuel costs, and marketing costs are still facing the company. So that is a bit of a concern here. Now, the company also released a few targets. So they introduced its Sea Change program with a few strategic objectives going forward to 2026, which include more than a 20% reduction in carbon intensity compared to 2019. So they're trying to reduce their carbon footprint. 50% increase in adjusted EBITDA compared to their 2023 June guidance, which I had up on the screen previously, which represents the highest level in almost 2 decades if they can achieve it. Adjusted return on invested capital of about 12%. And these estimates are based on net capacity growth of less than 2.5% compounded annually from 2023. And by the end of 2026, the company is expecting to approach investment-grade leverage metrics, as both Moody's and S&P had downgraded them to non-investment grade following the pandemic. So to conclude, overall, I think that Carnival Corporation is in the right direction as the financials appear to be on the path to returning to pre-pandemic levels, with bookings increasing to record levels and the company beating its Q2 guidance. But the company still has a lot of work to do as its profitability remains depressed and has a very levered balance sheet, which is a concern. And given the elevated debt levels and continued cost pressures, I do not believe that the stock would be worth an investment at this time, at least not until they can pay down a significant portion of their debt and show that they can continue to achieve their profitability targets going forward. And just on my note, I would never go on a cruise personally. So I don't think that I would invest in a cruise company unless they had, 20% growth at 10 times earnings. Then I couldn't turn it down. But at this point in time, I would not invest in Carnival. Okay.
Good assessment.
That's a massive bias. I don't know what we can say there.
It is a bias. I will say it is a bias, and it's an unreasonable bias. I don't
Brendan,
even
it's
know
not
why.
about the 7 times.
You got to be open-minded.
Yeah, it's not about the debt. It's all about just.
What's interesting to me is that bookings are at a record, even a pre-pandemic record, yet they're still not making money. Yep. Right. And they can't really add more debt. They don't want to issue shares or shouldn't add more debt. Rather, they probably don't want to issue shares at the current price. Yeah. So it's not plus we're in a situation where, we are in uncertain economic times, potentially entering into recessionary times. How does that impact their business? If they can't get profitability with record bookings now, what's it going to look like? When
despite like a bit of a denial from the average consumer, like inflation has squeezed disposable income, and cruises are part of disposable income. They should be facing a tougher time over the next 18 months than they likely faced over the past year. So in terms of, everybody just got back to traveling, was clamoring to go somewhere. Generally, there are people that still don't want to cruise right now, so maybe they get some of those
like more cost-effective ways to travel. Technically, again, you're talking
depending on. There's cruise A, cruise B are completely different.
Because you guys have been on some cruises before, and even I will say Ryan even kind of convinced me that I think a Mediterranean cruise actually would be cool because I love history.
Well, he's backtracking.
I don't know if I would say that their costs. They're more cost effective. Okay. You can spend a lot of money on a cruise.
Yeah, that's what I mean. Cruise A to cruise B is completely
relatively
different.
cheap if you want to, stay in hostels, or you can travel Europe, for at any price.
And you can be in a balcony room versus inside room versus suite versus you can spend unlimited amount on a cruise. You can spend unlimited amount on a hotel in a certain country.
One thing I will say is that if you know what to do, you can get good deals on cruises. So in some cases, maybe it is more cost.
Yeah, we've always gotten good deals. It's a great way if you've never been to Europe or through the Mediterranean. We saw 11 countries in a few weeks, and then you can maybe pick out one that you I really love this country. Then we can go back and spend a couple weeks there, a week there, whatever you want to do. If you went and said, I'm going to spend 2 weeks in country X, and you got there and you said, this sucks. Yeah, that would suck, right? So, it is a way to kind of sample. It's like going to a buffet and then you pick out, I like, Mexican food or something, and then you're going to go to a Mexican restaurant, right, Brennan?
I think try it. The other problem is I'm such a nervous Nelly that I think I'd be scared to leave the boat because I don't know if I'd make it back to the boat in time.
Oh, this is true.
This is so true.
We'll get to any city, an analyst city, and Brenny's so when do we have to go to the airport? It's 5 days from now.
One of the good things if you're in Europe, if you do miss the boat, is you can always just go to the next port. You can get there pretty quickly. I doubt it's that far
Brennan
away.
would just throw himself in the water before that happened. I'm done!
If you're doing I don't know, a cruise around Asia, and this is the last.
Yeah, you're done.
Last port before you head back to North America.
Well, I will say, this is a little shot at myself. My first time in Vegas, I was scared to leave the hotel room because I thought I was going to get lost in the casinos. Oh, yeah. I love making fun of myself.
Wow.
It's good.
It's a true story, though.
If you can't do it, right? Yeah. All right. That's good. All right. Well, that's going to end off our show this week. If you want us to keep putting out this content, like us on iTunes. If you're listening to this, rate and review us on there. If you are viewing this, smash that subscribe button on YouTube, and we'll continue to put that out. Keep your questions coming in for our Your Stock, Our Take, and we'll keep answering them every week. And as always, I wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.